folks, it's Adrian CryptoBurb speaking. Welcome to today's Friday webinar. Well, we've got the FOMC decision about the 75 basis point rate hike, and what we actually saw right after, following through an insane spike on the volatility, the markets actually just went down a little bit on the cryptocurrency scene and also on the overall stock market scene, right? The dollar keeps strengthening up, the yields keep shooting up. So we are continuing the recessive vibes that we've got so far in 2022. And what comes next? Well, you're about to find out in this video. If you're ready, make sure you stay tuned. We're going to right in a second. Welcome all over again. This is Adrian CryptoBurb, and I hope you guys are enjoying your beautiful day. I'm shooting this straight from Dubai. This is going to be a quick recap for everybody of only the biggest and the most essential points that you have to take away before the end of the week. And as we are heading towards the week end. Well, so let's just give it a go and start off with a very quick recap of what Chair Powell just said, on Wednesday during the FOMC. And I'm quoting Jonathan Ferro, very great personality in the world of Bloomberg. Bloomberg Business on Twitter. So feel free to give him a shout out. Shortly, Chair Powell, and I quote, "Want sufficiently restrictive rates, maintain that stance for some time. A ways to go before we get there. Want to avoid prematurely easing, committed to getting 2% inflation. We will keep at it until the job is done." And see Jackson Hole for more speech. And I think that this makes sense, that of course they are obliged to commit and tackle the inflation down. It's an exceptionally strong trend that they are trying to counter trade right now, and trends tend to persist, right? So once they actually catch the direction, it's very, very difficult to stop it. And because of it, I would argue that taking inflation down to 2% may be a very, very long lasting deal, right? So I wouldn't expect it to come overnight. I wouldn't expect it to come even this year, not even maybe in 2023, who knows? However, with the restrictive policy and monetary tightening, they're going to continue to fight the inflation, to combat the inflation, to let it cool off a little bit, just enough to keep the economy going eventually, because they need to find a balance between the hawkish environment that they create with the rate hikes and the overall monetary tightening, and at the same time not letting the economy fall into long-lasting winter, right? The recession is not really something that they really want to observe. However, this is what we've been for the reality over 2022 so far. So just taking it a step further, let's have a direct look, pre-market prices on the S&P 500. But before that, and the industrial Dow Jones average, just looking at it as it kind of like sinks below the support levels, just looking just at a chart, it doesn't really seem too much promising. There's been this follow through and close below the past support, the swing lows. We are getting dangerously close and near the area of June bottom, right? And because we got this failed pattern on top, this overthrow, it does make sense that failed patterns often perform better in the opposite direction. So we got this bullish break to the upside. However, it failed to maintain the support at 33,000 points, and as a result, it has become the failed pattern, and ever since the market has kept declining so far. And this same applies to S&P 500, to the SPX large cap index. So just looking at it, we are also looking at the very same pattern of an overthrow at the top, which commits to stronger outperformance, a stronger performance in the downwards direction. So I would argue that with following this overthrow on top, we may actually see the prices lower than 3,600 lows that we saw, in June. So this is getting us dangerously close to the actually breaking to the downside, on the stock market scene. And if that is the case, the energy also would not come off as much willingly, right? So we are definitely in a strong energy market, in a very strong bull market defined by the 200-day average and by the 50-day average. So both long-term trends and medium-term trends are ascending, and they are ascending quite surely and quite strongly. So just here looking at a little bit of a deterioration, and I should say maybe a slowdown to this overall short-term increase on a 20-day mean. This does not necessarily mean that the energy is, cutting It's cutting basically it's bullish run. Instead, I would argue that this is just a little bit of a sideways in this overall massive rally that had started in 2022. And historically speaking, this is of course been confirmed that anytime the energy spikes and sharply just grows and pumps massively, this typically leads to recession. At least that had been the case over the past years, past decades. And being the reality of recession, and heading into the winter, it may actually just face more headwinds in there. I would argue for the risk assets, as the energy is likely going to be getting more and more expensive, which may actually lead to even further geopolitical tensions and contribute perhaps just maybe to war escalation. So all of these factors are slowly getting priced in, I would argue, right? And the countries which are running out of the reserves, energy reserves, are going to be forced to buy in on an expensive energy resources. So it does not necessarily give anything promising to the risk market, because the energy works as a hidden tax. So if you have a higher hidden tax, this most likely is going to mean that you're going to have less disposable income to actually put in the investment markets, the financial markets. Taking it a step further, I want to introduce to you guys a dollar, but before I do, make sure that if you're watching this on our YouTube channel, make sure you actually leave the subscribe buttons, hit the like, smash the notification likes, hit the notification bell as well, so that you stay notified anytime we actually release and get this new piece of content for you guys. Everybody, this is very important to help us grow and produce even more content for you. And just taking it here, one cannot ignore how strong this dollar has been so far in 2022. Ever since, of course, the COVID came in, where we saw a little bit of a spike on the dollar, it did retrace. But ever since 2021 started, we've been seeing nothing but an exceptional rally, from 90 points on the Dixie up to 111.11. It's a funny number, five same digits. But this very breakout, it may look innocent, but it is actually heading an over 20-year high period, right? So 20-year highs are actually broken right now. The very last time that dollar was this strong was at the dot-com bubble. This is exceptional situation. And this breakout that we've just seen, it seems to persist. There is a lot of follow through. There is a lot of willingness and tendency to continue to move higher. I would not bet against that. And beyond that, the 50-month moving average, that blue curve is right here, it's just breaking over the couple of past year highs as well, right? So I would argue the dollar is in a monstrous bull market, and unless there's something to change that exceptionally, like suddenly and all of a sudden, then dollar is really set to continue. Technical target is somewhere closer to like 120 points for the measure rule movement, as you measure the base size between the swing lows and the swing highs, and take it basically, extrapolate a little bit in the vertical range upwards, which matches coincidentally, fairly the highs of the dot-com bubble for the dollar. So all those things combined, I would argue that we have to acknowledge for where Bitcoin positions itself there. And dollar definitely does not make it easier for Bitcoin to pump. There is, whenever Bitcoin USD pair, this is a currency pair, so whenever one side to the currency pair just pumps, the other one declines and gets weaker. So pumping dollar means typically weaker Bitcoin, and the other way around. So here, having very strong correlation at 0.76 between Bitcoin and other stocks, and then whatever stocks pump, the Bitcoin would pump more likely than not. However, it's not ever a promise. It's never a promise. It's never a guarantee. But all those things concerned, strong dollar commits more often than not to, combined with high energy prices, commits to recessive environment and utility stocks, utilities, consumer staples. Overall defensive sectors, just performing a little bit better than the S&P 500 as a benchmark. And Bitcoin here, being set positively and correlated positively and strongly with S&P 500 with strong dollar means that strong dollar typically leads to weak stocks, which typically, through the proxy of correlation, would lead to weak Bitcoin. So after rejecting time after time, the 200-week average, I would argue that Bitcoin is in a really is really stepping on a really thin ice. And this may happen that if it's supposed to continue, eventually there is this risk of breaking down, perhaps into the $14,000 with what many people would refer to as final capitulation, perhaps similar to what we saw in 2018 miners capitulation, right? Nobody knows what is going to happen. We don't know if it's going to perform exactly the same pattern as it did in 2018. However, still, the past can be a very valuable source of information, even for the seasonality. And the seasonality is exactly what I wanted to bring to you guys, because even the chart is not looking good, right? Even the chart is not looking to most optimistic, and there's been a lot of bearish pressures and a lot of recessive environments, strong dollar, high energy prices as we're heading into the winter. I would argue that what you guys may want to see is this seasonality pattern. And the seasonality pattern, as I scroll through my Twitter feed timeline, as I mentioned on yesterday's spaces, the seasonality pattern for Bitcoin tends to just put very unfavorable odds on September, yielding minus 6.64% on average monthly returns ever since 2011, right? For Bitstamp Exchange. So just having this note that September tends to be the worst performer of the year, it is often followed by, exceptionally better October, yielding ever since 2011 on the 11 years basis, close to 16% average return, followed by even stronger November historically with closer to 50% return on average, right? So of course, the more data sample, the better. Here we're talking about 11 years. The history of Bitcoin, financial history of Bitcoin is not the richest. It's just getting, it's still young. It's still, getting basically enough certainty with and as the time comes. So we need to be that just a little bit of skepticism to be put in there. However, the numbers and odds are clearly improving over the past years on average. So this is not just 1 year. This is an average return. There's this distinct increase and the biggest volatility in the positive direction for Bitcoin as we're entering October and November period. So Q4 tends to perform much better than Q3. Q3 tends to be negative. Q4 tends to be positive much more than not on an average basis. So I would argue that not everything is just lost just yet, and the bulls may still have the chance to recover, what they lost throughout 2022. Take it still with a grain of salt, I would argue, because we are all in this exceptionally difficult times, right? We are freshly off the pandemic tide, off the pandemic loop and craze. Then we are actually right now in the recession. We are in the very, very tense geopolitical moments and periods in the world globally, as as the energy is actually leading us into expensive Q4 as well, which may actually just make the markets underperform against their averages, right? Because when the markets perform better in the bull runs, they tend to go outside the average to the upside. However, when the markets, face the reality of pandemic, of recession, of geopolitical wars, this may cause the markets to underperform against their average historical returns. So just because November tends to yield closer to 50% average returns for Bitcoin, I would argue that this does not need to mean that it's going to shoot up like 200% or that is going to pump like 50%. Just maybe, because there is a lot of tensions, a lot of unpredictability, and a lot of uncertainty. Consumer sentiment is at historical lows. I would argue that this may take a toll and just put us in a little bit of concern whether or not we're going to meet the average returns. So here, taking it with a grain of salt, I would definitely invite you guys to come and join the Nest for 7 days free, because there are many questions you can ask, and I wish I had enough opportunities to actually talk to you guys every single day. And I know these questions can pile up, and that's why I'm inviting you to join the Burb Nest on a 7-day basis. Free trial, right? No credit cards, no strings attached, no credit cards, no money required. Just come and have fun for 7 days free. Nobody's going to chase your back for any sort of like penny. You have my word, and I'm my word over here. So come into the burbnest.com and come up, the upper right corner, sign up free, get us your email, get us your name, and we're going to set you up immediately and automatically so that you can enjoy stress less environment to learn, to improve, and to grow as a trader. And that is all, guys, I've got for you. Make sure you get your patience built, because the patience is what is going to be probably the keyword for 2022, as we are entering to the final stage. Well, the patience is a skill. You can craft the skill, you can master it, and the nest is going to help you do this. And I see you guys around. If you enjoyed this, make sure to hit the subscribe button, smash the likes, hit the notifications bells, and I see you guys on the next videos. God bless you all, and bye-bye.